Private equity firms have a big problem. They need cash, but the companies that they own may not be worth as much as they're telling people. And so instead of selling those companies to raise cash, they're turning to increasingly expensive debt in order to finance distributions to their investors. And this could be about to cause a very big problem. What's up, guys? I'm nobody special, and I am in Las Vegas for the Stock Pulse Silver Symposium today, hence the gaudy curtains and the wall behind me, and I am not in my usual studio, and I'm probably not going to be able to do my live stream this afternoon on Friday that I normally do, but I wanted to bring this story to you guys because this is an important story, and I caught it this morning when I was prepping for my morning live stream, and I'm starting to see an awful lot about this net asset value financing trend. It's gaining steam, and this could be a big problem in the making. And with that, we are going to shrink my big melon of a head and talk about this article that I saw in Bloomberg this morning. Private equity investors face an expensive choice: 10% loans to get cash, net asset value financing deals spread to limited partners, tepid merger and acquisition and secondary markets spurs a search for liquidity. So first, let's get a couple of things out of the way here. Private equity funds, guys, this is in Investopedia. Private equity is basically a type of alternative investment in which the investors purchase shares in privately held business. Private equity fund owns businesses, maybe not stocks. These are privately owned businesses, but they took out a big investment in them. And then if you invest in a private equity fund, you own a share of those privately held businesses. It's a way you can buy companies and businesses without accessing the stock market. Now, the thing about private equity is it is notoriously illiquid because this isn't part of a great big stock market with thousands or millions of buyers moving in and out. The prices of assets in private equity tend to be very volatile. They can swing up or down in very big moves because there just aren't that many buyers and there aren't that many sellers. Now, moving back to this Bloomberg article, they're talking about how M&A and secondary market activity has spurred a search for liquidity because the economy is slowing. Interest rates are rising. We know we're in an asset bubble. A lot of people, self included, have called it the everything bubble. And so there aren't many mergers and acquisitions happening. Companies aren't buying and selling each other like crazy right now. There's also not a lot of IPOs going on or initial public offerings. That's when sometimes private equity firms take their businesses and they sell them into the stock market. There's not a lot of that happening right now, which means these private equity firms that all made big investments in all these private companies are having a hard time raising cash. There's not that many buyers for these companies. The companies are overvalued, but they need cash. So what are they doing? They're turning to these NAV financing deals or net asset value loans. Reading on here, investors with money stranded in private equity funds are weighing an expensive solution: borrowing against their stakes, sometimes at double-digit interest rates, until the market for their holdings turns around. These guys need cash. They don't want to sell the companies because they're afraid the values might drop too fast. So they're borrowing against them. But remember, Jay Powell over at the Fed, he's been raising interest rates. So borrowing against them is getting very expensive. Guys, this is a huge market. This could cause a big problem. Net asset value financing to free up cash has already taken off among private equity firms holding $4.8 trillion of assets who have balked at selling investments amid a soft market for mergers and acquisitions. Now lenders are pitching those firms' clients on loans as well. Lenders such as 17 Capital, Apollo Global Management, and Ares Management see a growing market targeting investors in the PE funds. The PE is private equity. In theory, it's a more attractive way for pensions and other institutional investors to raise cash instead of selling their fund holdings at today's painful discounts. The loans could help them generate liquidity to invest elsewhere and fix their bloated allocations to private equity. Now, there are so many red flags here, I don't really know where to begin. First of all, pensions. Anytime I see pensions involved, I get nervous because pensions is kind of like the exit liquidity of last resort for all the dirtbags in Wall Street. If you've got toxic assets like commercial real estate or stocks and companies that aren't worth spit, a great way to get out of that investment is to try to sell it to pension funds, because pension funds are usually run by guys who don't have skin in the game. If you wine them and dine them, you can convince these guys to invest their pensioners' money into whatever asset you're selling. And so this is a place where they like to park a lot of these toxic investments. During the GFC, a lot of CDOs were sold to pension funds. Again, it's like the exit liquidity of last resort for unscrupulous Wall Street types. And in this case, there's these pension funds, these net asset value loans, they're being sold to pensions. So that makes me nervous there. But the other thing is they're talking about raising cash instead of selling their funds holdings at today's painful discounts. Well, here's the thing, guys. If you don't want to sell today's holdings at today's painful discounts, another way to say that is these companies that are sitting in private equity firms are not worth as much as they're telling us, because if they sell them, they won't get that much money for them. So they're saying we don't want to sell at these painful discounts. So the solution they're proposing is to borrow against them at today's painful interest rates, as if that's a better idea. So now not only do you hold an asset that is going down in value very rapidly and could go down even more if the economy continues to slow, but you're borrowing against it, so you're taking on expensive debt. You're getting the worst of both worlds here. You're holding on to an asset that's falling in value, and you're taking out expensive debt. Now, I also just want to ask here, the downside is high cost. Interest rates can run from 8 to 10%. And the potential for big losses if values erode on their private equity holdings, some of which are already highly leveraged. So here you got one more aspect of high levels of debt in the everything bubble, where you've got these companies that are sitting on the balance sheets of these private equity funds. And these companies are notoriously hard to value because they're illiquid. There's not many buyers and sellers for these companies. So the prices swing violently up and down. They're telling us there's not many buyers. They're worried about rapid downside risk. And so they're taking out expensive debt against them. But it gets even worse, guys, because I did a little bit more digging and I came across this article. This is in privatefundscfo.com from August 1st. Crucial questions about NAV. Is NAV financing an alternative to a secondary sale? They're basically saying, is this really a better option than just selling these assets? Is it really better to borrow against companies that are going down in value than it is to just sell those companies, just eat the loss? Now, here's what really stuck out at me. Private equity is suffering from a dearth of distributions. The M&A and IPO markets are both ostensibly shut, and yet investors urgently require capital back as they find themselves significantly over-allocated to the asset class and unable to commit new funds. Now, this is where this went from, okay, this might be a problem, to, wow, this might be a huge problem, because that first sentence, wow, that first sentence, private equity is suffering from a dearth of distributions. That's word salad, all right? A dearth means scarcity or a shortage of, and distributions is profits from private equity funds. That's the form of how you make money invested in private equity. You get distributions; those are your profits. When the companies sell, then you get distributions from the PE fund. That's how you make your money. Now they're saying because there's no mergers and acquisitions and because the IPO market is frozen, that there are no profits in private equity. And so what are they doing? They're borrowing money against their assets in order to pay distributions to investors. They're taking on debt in order to make it look like profits. And remember, when you take on debt, you're selling debt, basically. You're selling another investment, that debt. So you're selling new investments to pay profits on old investments. Well, that sounds an awful lot, maybe not perfectly, but sounds an awful lot like a Ponzi scheme. It's not a perfect match here. All right, let me just define a Ponzi scheme. A Ponzi scheme is a fraudulent scheme that involves paying existing investors in a non-existent enterprise with the funds collected from new investors. Now, NAV loans, net asset value financing, does not meet this definition of a Ponzi scheme. And the reason why there is because of the phrase a non-existent enterprise. Most Ponzi schemes are fake businesses, right? So NAV financing does not meet the threshold of a Ponzi scheme. I want to make that pretty clear here. I'm not accusing people of running schemes. But this NAV financing, what they are doing is they're bringing in new investors. They're selling debt against these companies, but these companies are overvalued And you could argue they're holding these companies on their books at artificially inflated valuations. And while I leave it up to you whether you think that's fraudulent or not, let me know in the comments if you think it's fraudulent or maybe it's just risky. It's kind of a big difference between the two here. So what NAV financing is it's a scheme that involves paying existing investors in an enterprise that is overvalued and not worth as much as it's claimed to be worth with funds collected from new investors. They're paying the profits out by borrowing against overvalued assets. Now, again, I just want to drive home that this does not meet the textbook definition of a Ponzi scheme, but it absolutely is Ponzi-like. And it's just one more chapter of this everything bubble where they're resorting to increasingly higher levels of leverage and debt in order to keep these assets valuations high. If these PE funds were to do what they normally would do, which is sell these companies to make a profit, well, then these companies would drop in value very quickly and there would be no profits. And so what they're doing is they're taking on expensive debt to maintain the illusion of profits. And we know how this ends, guys. This never ends well. Once again, I want to thank you guys for your time and welcome everybody to Las Vegas who came out to the Stock Pole Silver Symposium. I am really looking forward to meeting you guys tonight. And I will be back in the studio early next week with my regularly scheduled live streams. And until next time, live small and dream big.